Looking to add a high-quality compounder to your portfolio? Want a double-digit dividend growth rate backed by a super low payout ratio? Like the idea of getting a good deal on a great dividend growth stock after its pricing has collapsed? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel. I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is one of the largest retailers in the United States. Retailing is a tough gig. Because of that, it can act as a filter. Only the greats survive and only the best of the best thrive. Well, this retailer has been thriving for years. I don't see why it won't continue to thrive. And that should mean high revenue and profit and a bigger dividend. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Dollar General Corp, which appear to be trading at a significant discount today. Dollar General Corp, stock ticker DG, is an American chain of neighborhood general stores that focus on low-cost merchandise. Founded in 1939, Dollar General is now a $37 billion by market cap retail monster that employs 170,000 people. The company groups its merchandise into 4 categories: consumables, 80% of fiscal year 2022 sales, seasonal, 11%, home products, 6%, and apparel, 3%. There are nearly 20,000 Dollar General stores spread out across 48 different U.S. states. Dollar General has a unique retailing strategy that aims to serve thinly populated rural areas across the U.S. This provides Dollar General with 2 distinct advantages. First, these communities have few, if any, competing retail choices. This means limited competition to pressure Dollar General. It also creates a situation where the local populace is captive to the convenience that Dollar General provides. Second, and because of limited competition, Dollar General can offer suitable, low-cost merchandise without sacrificing too much on margins. See, these rural communities tend to feature lower-income households, roughly $40,000 annually. As such, affordability is a prime concern for these households. As you might gather by its name, Dollar General's specialty is affordability. Approximately 20% of a store's product assortment is priced at $1 or less. Furthermore, since most of its merchandise is focused on everyday consumables, the repeatability and predictability of business is very high. It's a recipe that Dollar General has followed to great success thus far, and I don't see anything on the horizon that threatens that success, which bodes well for the company's ability to continue growing its revenue, profit, and dividend. To date, the company has increased its dividend for 9 consecutive years. It's a young track record, sure, but Dollar General is off to a fast start. The 5-year dividend growth rate is 15%. That's quite impressive. What might be even more impressive is the fact that the payout ratio is only 22.2% even after all of that dividend growth. However, it's tough to have it all. The stock's yield is only 1.4%, so investors are giving up a bit of yield in order to access the double-digit dividend growth rate. That said, this yield is 60 basis points higher than its own 5-year average. For dividend growth investors who gravitate toward compounders, these metrics are pretty compelling. Looking at business growth, Dollar General moved its revenue from $17.5 billion in fiscal year 2013 to $37.8 billion in fiscal year 2022. That's a compound annual growth rate of 8.9%. Very, very strong. I usually like to see a mid-single digit top-line growth rate from a mature business, seeing as how Dollar General has more retail locations than any other retailer in the entire US. I'd say that Dollar General is fairly mature, yet the company delivered excellent revenue growth. Earnings per share grew from $3.17 to $10.68 over this period, which is a compound annual growth rate of 14.5%. That is outstanding. We can see how tight the relationship is between EPS and dividend growth, which also helps to explain the low payout ratio. Instead of blowing up the payout ratio, Dollar General has been fueling high dividend growth with high EPS growth. Excess bottom line growth can be mostly explained by a prolific share buyback program that saw the outstanding share count get reduced by 30% over the last decade. Looking forward, CFRA believes that Dollar General will grow its earnings per share at a compound annual growth rate of 6% over the next 3 years. While I don't think a 6% compound annual growth rate is bad at all relative to the recent past, it's not all that great. If this forecast is materialized, it would represent a material slowdown in earnings per share growth for Dollar General. CFRA seems to believe that it's more of a temporary bump in the road than a structural problem with the business model, which I agree with. CFRA cites near-term pressure on operating margins, and I quote, largely due to negative sales mix, increased shrink, e.g. theft, and investments in store labor hours and repairs and maintenance, unquote. However, CFRA then follows that lineup with this statement. Again, and I quote, longer term, however, we're positive on Dollar General growing operating margins to above 10%, unquote. I should note that a mild recession has been supposedly on the horizon for the US for the greater part of a year now. While a recession hasn't really shown up yet, and while it may not show up at all, it's a possible issue for Dollar General. CFRA notes this chink in the armor, again, and I quote, Dollar General stores primarily serve rural areas, catering to consumers with an average annual income of less than $40,000. As a result, Dollar General's core customer is particularly susceptible to weak economic conditions, unquote. Dollar General offsets this with low-cost merchandise, which should help to cushion the business against a major drop in business during any widespread economic weakness. On the other hand, another chink in the armor might be the store count. In some ways, Dollar General is a victim of its own success. With nearly 20,000 stores across the US, Dollar General operates more physical retail locations than any other retailer in the US. The company does plan to open almost 1,000 new stores in the current fiscal year, so market saturation is apparently not yet at a critical level. I see CFRA's projection as reasonable, if slightly pessimistic. Either way, with the payout ratio being so low, Dollar General could easily grow its dividend at a high single-digit rate under this framework. From there, an acceleration back into the low double-digit area would be quite feasible. It's a compounding machine that doesn't seem to be broken or out of fuel. Moving over to the balance sheet, Dollar General has a rock-solid financial position. The long-term debt-to-equity ratio is 1.3, while the interest coverage ratio is 13. There has been some balance sheet weakening in recent years, and the low common equity makes it look worse than it really is. But this balance sheet is still quite strong. Profitability is quite robust over the last 5 years. The firm has average annual net margin of 6.8% and annual return on equity of 33.5%. By the standards of a retailer, Dollar General's returns on capital are extraordinary. And with economies of scale, brand recognition, a built-out footprint in underserved communities, and a focus on low-cost merchandise, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Retail is notoriously competitive, although Dollar General circumvents much of this by operating in areas with limited competition. There are effectively no switching costs present, but a dearth of alternatives in local markets creates sticky customers. A recession would likely impact Dollar General, and its customer base could be especially vulnerable to an economic ebb, but a sizable portion of Dollar General's merchandise is consumable, non-discretionary, and affordable. The balance sheet remains a strength, but further weakening here is something to watch for. Dollar General has no real exposure to e-commerce, instead relying on its merchandising strategy, which could be a key issue. There are no barriers to entry, and future competitors could easily enter Dollar General's markets. Dollar General staffs stores at a bare minimum, which may be part of the shrinkage problem for the company, and hiring more staff would come at a time in which wages have been on the rise. Saturation may be the biggest challenge of all, as the company's physical store count is by far the most out of any retailer in the US. These are definitely some risks to consider, but the growth and quality of the business are also considerations. And with the stock down more than 30% year to date, its valuation has become one of the biggest considerations of all. The stock's price earnings ratio is 15.7. To put that in perspective, its own 5-year average PE ratio is 21.6. This is a stock that has often been expensive, but the mighty have fallen. The sales multiple of 1 is also well off of its own 5-year average of 1.5, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a 2-stage dividend discount model analysis. I factored in a 10% discount rate, a 12% dividend growth rate for the next 10 years, and a long-term dividend growth rate of 8%. This is a unique dividend growth stock in some ways, which makes it difficult to confidently value. On one hand, a case could be made that these growth rates are somewhat aggressive. Markets are fairly saturated. The last dividend increase was less than 8%, and the near-term forecast for EPS growth is middling. On the other hand, Dollar General has a great track record for revenue, earnings per share, and dividend growth over the long run. Plus, it has one of the lowest payout ratios I've come across, which provides a lot of flexibility with the dividend. The next year or two is iffy, to be honest, but it's hard to imagine Dollar General coming woefully short of these projections over the next decade or so. The dividend discount model analysis gives me a fair value of $178.70. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates DG as a 4-star stock with a fair value estimate of $191. CFRA rates DG as a 4-star buy with a 12-month target price of $197. I came out the lowest, but we're all below the $200 mark, a mark this stock has been above for a number of years now, and that just goes to show why I've long thought it was just too expensive. Averaging the 3 numbers out gives us a final valuation of $188.90, which would indicate the stock is possibly 12% undervalued. Here's the bottom line, guys. Dollar General Corp is a great retailer that has thrived by pursuing a unique strategy that limits competition with a market-like yield, a double-digit dividend growth rate, a very low payout ratio, nearly 10 consecutive years of dividend increases, and the potential that shares are 12% undervalued. The stock's recent drop in pricing may have finally created a long-term investment opportunity for dividend growth investors. And now for a special news announcement. Realty Income Corp, stock ticker O, invested $2.6 billion in properties in April and May at an initial weighted average cash lease yield of 6.8%. Realty Income just keeps moving the dial. For income-oriented dividend growth investors, this dividend aristocrat, which pays its big dividend monthly, is almost a must-own. Don't forget about Realty Income.
Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alert. I'll see you next time.